Preparing for a financial analyst at SSE interview? You've reached Candy Mentor, and this video is for you. We'll walk through 25 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to become a financial analyst at SSE? I want to join SSE because financial analysis here supports both commercial performance and the transition to a lower carbon energy system. The role would let me apply forecasting, variance analysis, and investment appraisal to assets with long-term strategic importance. I am particularly attracted to the balance between financial discipline and public impact. I would bring strong attention to detail, curiosity about the energy market, and the ability to explain complex findings clearly to operational and senior stakeholders. While answering, connect your analytical skills to SSE's renewable energy, electricity networks, disciplined investment, sustainability objectives, and purpose-led culture. Show genuine interest in supporting decisions that affect customers, shareholders, and the energy transition. Question 2. What do you understand about SSE's business model? SSE operates across energy generation and electricity networks, with a strong focus on renewables and infrastructure. Its business model combines market-exposed activities, such as generation, with regulated network operations that earn returns based on investment and regulatory frameworks. This creates different revenue, risk, and forecasting characteristics across divisions. As an analyst, I would avoid viewing the group as one uniform business and instead understand each segment's drivers, capital needs, regulatory assumptions, and contribution to long-term value. Make sure to cover SSE's exposure to renewable generation, electricity transmission and distribution networks, flexible energy assets, regulated returns, wholesale markets, capital intensity, and the importance of balancing growth with affordability and reliability. Question 3. Walk me through the 3 financial statements and how they connect. The income statement shows revenue, costs, profit, and earnings for a period. Net income flows into retained earnings on the balance sheet, while non-cash expenses such as depreciation reduce profit but are added back in operating cash flow. Capital expenditure increases property, plant, and equipment and reduces cash. Financing activities explain changes in debt or equity. The balance sheet must balance, and the cash flow statement reconciles opening to closing cash, linking profitability with liquidity. In your answer, explain the income statement, balance sheet, and cash flow statement, then link net income, retained earnings, depreciation, working capital, capital expenditure, debt, and cash using a simple integrated example. Question 4. How would you build a monthly forecast for an SSE business unit? I would begin with historical actuals and identify the operational drivers behind revenue and costs, such as generation volumes, achieved prices, customer numbers, maintenance activity, and headcount. I would then build monthly assumptions, reflect seasonality, incorporate approved business plans, and validate them with operational owners. Finally, I would compare the forecast with prior periods, create upside and downside cases, investigate unusual movements, and document assumptions so the model remains transparent and auditable. Be sure to mention historical actuals, operational drivers, volume and price assumptions, seasonality, contract data, management input, scenario ranges, variance checks, version control, and clear documentation of judgmental assumptions. Question 5. What is variance analysis, and how would you perform it? Variance analysis explains why actual results differ from budget, forecast, or prior year. I would decompose the movement into price, volume, mix, timing, efficiency, and exceptional items, then assess materiality and controllability. For example, lower generation revenue might reflect weaker output, lower market prices, or timing differences. I would discuss the drivers with the business owner, update the forecast where appropriate, and present the conclusion with a recommended action, not just a numerical bridge. Focus on separating price, volume, mix, timing, FX, efficiency, and one-off effects. Explain how you would investigate material variances, engage budget owners, distinguish controllable from uncontrollable items, and communicate actions rather than merely reporting differences. Question 6. How would falling wholesale electricity prices affect SSE's financial performance? The impact would depend on SSE's hedging profile, generation mix, contract terms, and timing. Lower prices could reduce realized revenue and margins for unhedged generation, while hedges may delay or soften the effect. Networks would generally have different, regulated revenue drivers. I would quantify the exposure by asset and period, assess cash flow and covenant implications, review impairment indicators, and test downside scenarios. I would also distinguish temporary market volatility from a sustained change in long-term assumptions. In your answer, distinguish unhedged from hedged exposure, generation volumes, realized prices, contract structures, impairment risk, network revenues, customer affordability, and possible effects on earnings, cash flow, and valuation. Question 7. How do you evaluate a major renewable energy investment? I would forecast construction spending, operating costs, generation volumes, degradation, realized power prices, contract revenues, taxes, working capital, and decommissioning obligations. I would discount the resulting free cash flows using a risk-appropriate WACC and assess NPV, IRR, and payback. Because the outputs are assumption-sensitive, I would test power prices, delays, CapEx overruns, availability, and financing costs. I would also consider strategic value, grid constraints, regulatory support, and execution risk alongside the headline return. Make sure to cover forecast cash flows, capital expenditure, operating costs, generation assumptions, power prices, subsidies or contracts, taxes, financing, NPV, IRR, payback, WACC, sensitivities, and strategic or regulatory considerations. Question 8. What is NPV, and why is it useful for SSE? Net present value is the present value of forecast incremental cash inflows and outflows, discounted at an appropriate rate, less the initial investment. A positive NPV indicates value creation relative to that required return. For SSE, NPV is useful because infrastructure projects involve large upfront spending and benefits over many years. I would never treat it as automatic truth. I would challenge the operating assumptions, test sensitivities, check model integrity, and compare NPV with strategic, regulatory, and execution considerations. Explain that NPV discounts future incremental cash flows to present value and compares them with investment cost. Mention value creation, timing, risk-adjusted discount rates, mutually exclusive projects, and limitations around uncertain assumptions. Question 9. How would you calculate free cash flow? For unlevered free cash flow, I would start with EBIT, apply taxes on operating profit, add back depreciation and other non-cash charges, subtract capital expenditure, and adjust for changes in operating working capital. I would exclude financing flows because the cash flow is available to all capital providers. For levered cash flow, interest and debt movements are included. The definition must remain consistent with the discount rate, valuation method, and project assumptions being used. Discuss operating cash flow, taxes, capital expenditure, working capital, restructuring or exceptional items, and the distinction between unlevered and levered free cash flow. Emphasize consistency with valuation and financing assumptions. Question 10. What is WACC, and what factors influence it? WACC is the weighted average cost of a company's debt and equity financing, adjusted for the tax benefit of interest. Equity cost commonly uses the risk-free rate plus beta multiplied by the equity risk premium, while debt cost reflects borrowing rates and credit risk. The weights should generally use market values. For SSE, I would consider business mix, regulation, leverage, asset life, and market exposure, because a regulated network and a merchant generation project do not carry identical risks. Be sure to explain the weighted cost of debt and equity, market values, tax shield, risk-free rate, beta, equity risk premium, credit spread, leverage, and why regulated and merchant businesses may require different risk assumptions. Question 11. How would you analyze a budget that is 10% over plan? I would first confirm that the comparison uses consistent scope, timing, currency, and accounting treatment. Then I would bridge the 10% variance by category and identify whether it reflects volume, pricing, timing, efficiency, project changes, or one-off costs. I would speak with budget owners to validate the operational explanation and assess whether the overspend will recur. Finally, I would update the forecast if necessary, highlight risks clearly, and propose practical controls or savings actions. In your answer, explain how you would validate the data, quantify material drivers, separate timing from permanent overspend, assess forecast impact, speak with owners, and recommend corrective actions without assigning blame. Question 12. What financial KPIs would you monitor for an SSE renewable asset? I would monitor generation against budget, capacity factor, availability, curtailment, achieved price, revenue, EBITDA, operating cost per megawatt hour, and cash conversion. I would also track CapEx progress, forecast completion cost, safety performance, carbon metrics, and debt service coverage where relevant. The key is connecting operational drivers to financial outcomes. For instance, low revenue might result from weak availability, low prices, or curtailment, and each requires a different management response. Focus on generation, capacity factor, availability, achieved price, EBITDA, operating cost per unit, CapEx variance, cash conversion, safety, carbon intensity, and debt service, explaining why operational and financial measures must be linked. Question 13. How does working capital affect cash flow in an energy business? Working capital can create significant cash swings even when reported profit is stable. Higher receivables consume cash, while higher payables provide temporary funding. Inventory and commodity collateral can also be important. In energy, settlement timing, customer collections, seasonal demand, and margin requirements may amplify movements. I would monitor days sales outstanding, overdue balances, payment terms, and forecast cash needs. That helps distinguish a temporary timing effect from deteriorating collections or a structurally cash-intensive business model. Mention receivables, payables, inventory, collateral or margin requirements, customer payment behavior, commodity settlements, seasonality, and the distinction between accounting profit and actual cash availability. Question 14. What accounting issues are particularly relevant to SSE? SSE's asset-intensive model makes property, plant, and equipment, depreciation, impairment, leases, and decommissioning provisions especially relevant. Wholesale contracts and energy derivatives also require careful valuation and hedge accounting analysis, while revenue recognition depends on the underlying arrangements. I would focus on the substance of each transaction, confirm the applicable International Financial Reporting Standards policy, document assumptions, and involve technical accounting specialists when needed. Accurate accounting matters because small assumption changes can affect earnings, asset values, covenants, and investment decisions. Be sure to discuss property, plant, and equipment, depreciation, impairment, provisions, leases, derivatives, revenue recognition, decommissioning obligations, regulatory balances, and the importance of applying International Financial Reporting Standards policies consistently. Question 15. How would you assess whether an asset impairment is required? I would begin by identifying impairment indicators, such as sustained price declines, weaker output, regulatory changes, cost overruns, or physical damage. I would then compare the asset or cash-generating unit's carrying value with its recoverable amount, using value in use or fair value less costs of disposal. The model would incorporate realistic production, price, cost, and discount rate assumptions. I would challenge sensitivities, document management judgment, and ensure any impairment is recognized promptly and consistently. Explain impairment indicators, recoverable amount, value in use, fair value less costs of disposal, cash-generating units, discount rates, terminal assumptions, and sensitivity analysis around prices, output, costs, and useful lives. Question 16. How would you use Excel to analyze financial performance? I would use structured data tables, pivot tables, SUMIFs, XLOOKUP, and scenario controls to analyze performance efficiently. I separate inputs, calculations, and outputs, avoid unnecessary hardcoding, and include checks for missing data, balance errors, and unusual movements. For management reporting, I would use concise bridges and charts that highlight the drivers. I also protect formulas, maintain version control, and make the model easy for another analyst to review, update, and challenge. Mention structured models, pivot tables, SUMIFs, XLOOKUP or index match, scenario tools, charts, error checks, data validation, version control, and avoiding hardcoding. Emphasize that efficiency cannot compromise reviewability. Question 17. Tell me about a time you found an error in a financial model. In a previous analysis, I noticed that forecast cash flow improved despite a large increase in capital expenditure. I traced the model and found that one project cost had been linked to the prior month's input. I checked the impact, informed my manager with a clear explanation, corrected the formula, and reran the outputs. I then added a cross-check comparing project schedules with the cash flow model. The experience reinforced the importance of reasonableness checks, not just formula accuracy. Be sure to structure the example using situation, task, action, and result. Highlight how you isolated the error, assessed impact, communicated professionally, corrected the process, and prevented recurrence. Question 18. How would you explain a complex financial result to a non-finance stakeholder? I would lead with the practical conclusion, then explain the 2 or 3 drivers that matter most. For example, instead of saying margin declined because of unfavorable price variance, I would say lower market prices reduced earnings despite production exceeding plan. I would use a simple chart or bridge, explain any assumptions, and relate the result to the decision required. I would invite questions and confirm understanding rather than assuming a technically correct explanation is automatically useful. Focus on starting with the conclusion, using plain language, linking financial movements to operational drivers, avoiding unnecessary jargon, checking understanding, and tailoring the level of detail to the stakeholder's decision. Question 19. What would you do if an operational manager challenged your forecast? I would first understand which assumption the manager disagrees with and why. They may have current operational information that the model does not capture, so I would test the evidence against source data, contracts, and historical performance. If the assumption is valid, I would update the forecast and document the change. If uncertainty remains, I would present a range with explicit risks. My role is not to defend a number, it is to produce the most credible decision-useful view. In your answer, emphasize listening, understanding operational evidence, testing assumptions, separating facts from opinions, reconciling data sources, maintaining independence, and agreeing a documented resolution or escalation path. Question 20. How would higher interest rates affect SSE and its investment decisions? Higher interest rates would generally increase borrowing costs and potentially raise the cost of equity and WACC. That lowers the present value of long-dated cash flows and can make marginal projects unattractive. Existing debt exposure, refinancing dates, and hedging would determine the immediate cash impact. I would update financing assumptions, stress test coverage ratios and project NPVs, and consider phasing or reprioritizing capital. For regulated assets, I would also examine how the regulatory framework allows financing costs to be recovered. Discuss higher financing costs, WACC, project NPV, debt service burden, refinancing risk, valuation multiples, customer affordability, regulated returns, and the importance of distinguishing short-term hedging from long-term economics. Question 21. How would you incorporate scenario analysis into a business plan? I would establish a base case using the most supportable assumptions, then create upside and downside cases based on specific drivers such as power prices, generation, inflation, delays, CapEx, or regulation. Each scenario should show effects on revenue, EBITDA, cash flow, leverage, and investment returns. I would avoid arbitrary percentage changes and explain the operational logic. The final output should identify trigger points and management actions, so scenarios support decisions rather than simply displaying a range of numbers. Make sure to cover base, upside, and downside cases, identifiable drivers, probabilities where appropriate, sensitivities, management actions, liquidity implications, and presenting scenarios as decision tools rather than predictions. Question 22. What are the main financial risks in a large infrastructure project? The main risks include construction delays, cost overruns, supply chain constraints, permitting, grid connection, contractor failure, inflation, interest rates, regulatory changes, and weaker than expected operational performance. I would quantify each risk, assess probability and impact, and distinguish risks already mitigated through contracts, insurance, hedging, or contingencies. Strong governance requires stage gates, independent review, and regular forecast at completion updates. Financial analysis should therefore track both the expected return and the resilience of that return under realistic adverse conditions. Discuss construction delays, cost overruns, permitting, grid connection, supply chain, contractor performance, commodity prices, interest rates, regulation, operational availability, and mitigation through contracts, contingencies, insurance, and governance. Question 23. How would you assess SSE's performance against a competitor? I would first ensure the comparison uses comparable businesses, periods, currencies, and accounting definitions. I would examine revenue and EBITDA growth, margins, return on capital, capital expenditure, leverage, cash conversion, and valuation, then connect those metrics to generation mix, asset quality, regulation, and operating performance. I would avoid concluding that a higher margin automatically means superior performance, because business risk and investment stage matter. The analysis should explain both the numerical gap and the underlying economic reason. Focus on comparable segment definitions, revenue and EBITDA growth, margins, capital intensity, leverage, returns, generation mix, operational KPIs, regulatory exposure, and normalization for accounting or market differences. Question 24. What does sustainability mean from a financial analyst's perspective at SSE? Sustainability affects financial decisions because it influences asset demand, regulation, financing, operating resilience, and long-term valuation. At SSE, I would consider carbon exposure, renewable investment, biodiversity, supply chain standards, safety, and customer affordability within forecasts and investment cases. I would translate those issues into cash flows, risks, and required returns where possible, while tracking relevant non-financial KPIs. Good analysis recognizes that sustainability is not an additional narrative, it can materially shape the economics and durability of an asset. In your answer, link sustainability with capital allocation, transition risk, asset longevity, carbon costs, financing access, regulation, stakeholder trust, operational resilience, and measurable financial outcomes rather than treating ESG as separate reporting. Question 25. Describe a time you had to prioritize competing deadlines. During a reporting cycle, I had to complete a management pack while supporting an urgent forecast request. I listed the deadlines, assessed which outputs affected senior decisions, and agreed priorities with my manager. I completed the critical forecast first, reused validated data where possible, and communicated a realistic delivery time for the pack. Before sending either output, I performed focused review checks on key totals and assumptions. Both deliverables were completed on time, and the experience improved my approach to planning under pressure. Be sure to demonstrate planning, materiality judgment, communication, ownership, quality control, and escalation. Use a specific example showing how you protected critical deliverables while managing stakeholder expectations. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.